Simon? Welcome back, by the way.
Thank you. So I'm Simon Johnson, and thanks very much for inviting me, and thanks for organizing another great conference. What could cause the next financial crisis? I have three things to say. First of all, I don't know. And you don't know, and nobody knows. I worked on financial crises for 25 years. I was, in 2007 through August 2008, the chief economist of the International Monetary Fund, just down the street. I attended a lot of very interesting meetings during that time period with top officials and top private sector people, people who know as much as can be known about the world's economy and the world's financial system. And they, collectively and individually, had no idea what was happening and what was going to happen in September 2008. The second thing I would say is look around the world. The European situation, you heard a very nice summary just now. I'm much less sanguine about the political risks and the economic risks. I think ultimately Italy will have to restructure its sovereign debt. That's 2 trillion euros outstanding debt. And the consequences of that are effectively unknowable. But I wouldn't worry just about Europe. I would worry about Japan. I wrote an article with Peter Boone that appeared in The Atlantic at the end of September saying that Japan may well be the next financial crisis. And we talked about Japanese demographics, and we talked about Japanese fiscal policy, and we talked about the way that could impact both the Japanese economy and the world economy. And I have to say that when we wrote that article, it was met with a universal, global, stony silence. I don't know if you follow what happened in the Japanese bond market this week, the sell-off, the pressure that's now on the financial institutions. I'm not sure if you've kept track of the IMF's recent and rather extraordinary warnings about the interest rate risk held by large Japanese financial institutions. But if you're not aware of it, please do read the front page of the Financial Times today. But I wouldn't just worry about Europe and Japan. I would worry about China. I would worry about the financial risks in the Chinese economy. I'd worry about exactly the forms of unforeseen contagion that we have experienced again and again since the mid-1990s. And that brings me to my main point, which is, while I don't know where the shocks will come from, where the problems will emerge around the world, I do know one thing. We are not ready. Our financial system is not ready. We have not gone far enough with financial reform. I endorse and support everything that Dennis Kelleher said on the previous panel in that regard. And let me put it to you like this. JP Chase is the largest bank in the United States. It has a balance sheet of about $2.2 trillion under US GAAP. And when you see a lot of the comparisons of bank size around the world, people say, well, JP Chase, largest bank in the United States, is between number 6 and number 10 globally in terms of assets. All of those comparisons are wrong. They compare US banks under US GAAP with international banks, for example, European banks, whose balance sheets are measured under IFRS. Now, there is a fundamentally different treatment of derivatives under these two accounting standards. You might like US GAAP, you might like IFRS. We can have that discussion from an investor standpoint. From a regulatory risk standpoint, I like, and a lot of my former colleagues in official circles like IFRS. It's a less generous form of netting, but it has a better indication of the downside losses you may be facing as a taxpayer. If you convert JP Chase's balance sheet to IFRS, it's not $2.2 trillion. It's $3.9 trillion by our estimations. And it is by far the largest bank in the world. sorry, it's much larger than the European banks. It is the only other bank that's close to it in terms of total size is Bank of America. Now, this is a $16 trillion economy, roughly speaking. JP Morgan Chase, let's call it $4 trillion balance sheet. Let me ask you a very straightforward question. If JP Morgan Chase were to fail, or to be on the brink of failure, today, a Friday, would they be allowed to collapse like Lehman Brothers over the weekend? This is a hypothetical, just to be clear. I don't want to be the cause of the next crisis. Could JP Morgan fail, be allowed to collapse like Lehman? Anybody want to raise their hand? Could they fail? I see no hands. Could JP Morgan be taken over and managed through liquidation in an orderly fashion without causing disruption around the world, using Title II, the new resolution authority, the orderly liquidation authority of Dodd-Frank? Could that happen? Could orderly liquidation impose losses on some creditors to JP Morgan Chase? That's the essence of liquidation. Without that massively disrupting derivative markets, other financial markets, not just in the United States, but around the world. And let me make this question a little bit easier for you by telling you that there is no cross-border resolution authority. It's not legislated in Dodd-Frank. You can't legislate that. It's cross-border. It's not agreed among the G20 or the G7. The IMF has been telling the Europeans for 20 years they need a cross-border resolution authority within Europe, within the Eurozone, and they don't have one because governments won't agree to it. And by the way, if you did have a cross-border agreement on how to handle resolution, assets and liabilities with the French, you really think they would follow it in a crisis? Cross-border resolution of global megabanks is a physical, legal, economic, and political impossibility. You will not see it in your professional lifetimes, and I doubt that your children will see it. I stand with Tom Hoenig, formerly of the Kansas Fed, and now the FDIC, with Sheila Bair, former head of the FDIC. You must read her book, Bull by the Horns. And with Richard Fisher and Harvey Rosenblum of the Dallas Fed. Mr. Fisher says very clearly that our largest banks have become too complex to manage. They cannot be managed by their management. See the London whale at JP Morgan Chase for an illustration. See Barclays' involvement in LIBOR for a different illustration. They cannot be managed by their shareholders. We can talk about HSBC and Standard Chartered, money laundering. They cannot be managed or understood by their creditors. We have any number of failures across European big banks to look at for that. And they cannot be managed by their regulators, by their supervisors. The largest banks in the world and in the United States should be made smaller. Small enough and simple enough to fail. No funding advantage. This is not a market. There is nothing about a market in the structure. It is a vast, non-transparent, dangerous government subsidy scheme. You, the American taxpayer, directly and indirectly, particularly through the Federal Reserve, stand behind the balance sheet and the risks of JP Morgan Chase, whether you like it or not. This encourages them to get bigger. This encourages them to take more risk. They get the upside. The downside is someone else's problem. In a world with these uncertainties, in a world with these macroeconomic risks, in a world with so little capital in financial institutions, including in leading American-based global megabanks, in this world where the shocks from all kinds of places you could not have imagined, You must build a resilient financial system. That is what the economy needs. That is what the non-financial sector needs. You can listen to the lobbyists. You can listen to the special interests. And they will complain about their profits. And they will complain about the efficiency of the American economy. And they will threaten, perhaps gently, consequences for American economic growth. All of that is an illusion. All of that is a distraction. The real danger to the American economy in this context is that our largest banks will become bigger. They will take on a great deal of risk, and they will blow themselves up. And the costs of that, whether or not you save them or rescue them or use different terminology, the cost of that, well, the costs last time were estimated by Dennis Kelleher and his colleagues at Better Markets at at least $12.8 trillion, almost a year's worth of GDP. Next time could be worse. Next time the losses could be much greater. Next time the damage to all of us, to all American citizens, to our place in the world, could be much greater. Thank you very much.